Welcome back to Navigate Your Wealth, where today we are talking about how to remove your wealth from Washington, basically boiling it down, how you can potentially save money on taxes over your lifetime, not just this year. And so, Karen and Sam, I know we were talking in the last segment, and you shared some very powerful examples of what it could look like to go ahead and just rip that Band-Aid off. Pay tax now, yes, but you're paying less to the IRS than you would if you continue to kick that can down the road. It's hard to imagine once people see that, who doesn't want to pay less to the IRS, right?
The biggest challenge is often, do I pay the money net out of the account conversion, or do I have money on the side? You know, we had a client recently who had 4 years until retirement, and she said, I've got $200,000 a year that I want to put someplace. Does it make more sense to invest it, or does it make more sense to use that money to do Roth conversions? And so we ran the scenario both ways. We took 4 year scenario and invested the $200,000 a year, and then did the conversion and used the money to pay the taxes. And it was interesting because it actually came out better because her net spendable income, because of the conversion and getting that money into the Roth IRA faster, really was a win for her. So it was good that we were able to kind of, you know, go through and prove.
And I love that you can compare that side by side, because again, to your point, no two plans are alike, no two situations are alike. What's right for one person might not necessarily be right for the next person.
Yeah. Well, in her case, the Roth was the correct scenario, but there are other ways that you can look at tax-free options. So the first is a Roth IRA. The second is cash value life insurance. I know this is a resource that not a lot of people are familiar with, and life insurance sometimes gets a bad rap because they believe that it's all about the death benefit. There are living benefits in life insurance, and that's how we want to be able to utilize it for tax-free access for our clients.
Yes, so many solutions at your disposal. And I love, because you are independent too, you have every single vehicle, every single tool at your disposal to be able to help your clients and really figure out what's in their best interest.
I want to add one other thing to the tax-free options. There are really only 3 ways that you can get tax-free income. One is tax-free municipal bonds, and anybody can buy those. The challenge with tax-free municipal bonds right now is, again, we saw in 2022, as interest rates were rising, all bonds went down. So they aren't the safety net that a lot of people thought. But if you're looking for pure tax-free income, tax-free municipal bonds can do that. As Samantha said, cash value life insurance is a great tool. But I want to point out on the Roth and Roth conversion and Roth contributions, something that a lot of people question. I had a client who said, oh, I can't do a Roth conversion because I make too much money. And it turns out that she had it confused. Roth contributions are limited by an income threshold. But as of 2010, you can make any amount of money and you can convert any amount of your IRAs into Roth IRAs. There is no limit. So I just wanted to make that differential.
That's an important distinction, because a lot of folks have that misconception going on. Well, I know we have focused today's show. Of course, the title has been How to Remove Your Wealth from Washington, and you are very passionate about engaging in strategic tax planning. That is just one piece of what you do at Compass Financial. So what are some of the other concerns that are at the top of folks' minds that we need to make sure our viewers are aware of as well?
You know, I think that when we're looking at the ways that the government can control our dollars, we need to understand that there are 6 ways that the government and Washington still can hold the purse strings. So the first way is if you make more money. If you make more money, naturally you would grow to a higher tax bracket and you would pay more dollars. That one feels kind of obvious. The next way is if they raise taxes. We know that right now, with the way that the legislative law is laid out, that the Trump tax will sunset in 2026. Wow, tongue twister there.
It is.
So when those tax rates go up, even if you make the same amount of money, you could be paying more tax. The third way is that they could change tax deductions. You know, in the 80s and 90s, you know, you could deduct your Sears card. There were so many things that you could deduct. If they remove those things, now your standard deduction goes away and what you pay tax on can be greater. The fourth way is expanding taxes. Social Security used to be available to you 100% tax-free. Now, 85% of that, if you make too much money, which isn't actually a lot of money, can be taxable.
Yep.
So they have the opportunity to change that anytime in the future. The fifth way is legislative taxes. And in 2019, we saw that with the Secure Act, and then again with the Secure Act 2.0.
All the changes.
All of the changes. Now they're telling you how you can distribute the wealth, what your children need to do, how long they can have access to it, how long they can hold on to it before they have to take the money.
Right.
All of those things are up for re-election. And the last way is the saddest way, but it's what we call the widower's penalty. You know, when one spouse dies, the other spouse now has to file as single. And the single tax filer bracket is significantly higher than a married couple filing jointly.
With that same income.
That exact same income. Now listen, your spouse didn't eat that much. Your income, you know, isn't going down. You need these dollars. We don't want you to be in a position where all of a sudden Washington has control of your wealth.
You know, with those 6 points, Phyllis. Wow, Phyllis, Samantha. Isn't that something?
Too many client names going on too, right?
But the point that I want to bring out is that of all of those changes, the Secure Act, there was one good thing that came out of it. And I know we talk about Roth conversions all the time. And one of the things that I would say is with that Roth conversion, you no longer have to take required minimum distributions. So that's one good thing that the legislative changes have brought to the table. And here's why it's so impactful. If you have a Roth IRA, you yourself do not need to take required minimum distributions. When you pass, if there is a surviving spouse, he or she does not need to take required minimum distributions. And in the good old days, you used to be able to take your retirement accounts and stretch it out to your children for years and years to come. And they did take that away. They shortened it to a maximum of 10 years. But here's the good news. If the money is in a Roth IRA, your non-spouse beneficiaries do not need to take a required minimum distribution for those first 9 years. Think about all of that money that you now put into a tax-free Roth IRA. 9 years of compounding, 9 years of it being in an account that the government doesn't have a single claim to. And in the 10th year, they have to distribute it, but it's 100% tax-free.
Amazing. Gosh, we could continue this show for hours only if we had the time, right, to talk about such an important subject. But Sam, Karen, thank you for your wisdom. Thank you for your expertise. We hope you found this to be educational and valuable. That's how it's intended each and every week. But most of all, we hope you will take the action necessary to help yourself remove your wealth from Washington. But you don't have to go it alone. 855-348-3073 and the team of Compass Financial would love to help and serve you. Thanks so much for joining us. We look forward to being back with you next time on Navigate Your Wealth.